This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 266 was recorded on April 8, 2021. I'm Erik Townsend. This episode is brought to you by Abaxx Technologies, pioneering the design of smarter markets that better meet the needs of both market participants and society as a whole. Jesse Felder returns as this week's feature interview guest. Jesse sees inflation on the horizon, but don't worry, we really do have more deflationists booked in coming weeks. And Jesse has quite a bit to say about macro risk factors and where the S&P 500 may be headed next. Then be sure to stay tuned for our post-game segment when Patrick's chart deck will be titled, Time for Gold?
And I'm Patrick Ceresna. Now, Erik, let's jump to that S&P 500. Continues to crawl higher. We almost got up to 4,100. What's your take on where we're standing in the markets today?
Well, sure enough, another all-time high day on Podcast Day Thursday for 2 weeks in a row. Feels like the new normal economy once again. No change to my outlook, Patrick. I think all of the arguments for why valuations are overdone and overcooked and so forth here all make perfect sense. But frankly, I think what we have in progress is a crack-up boom, and I think markets could move a whole heck of a lot higher from here. Straddles are the way to play this. We've talked about that before in previous episodes.
All right, well, let's move on to that U.S. dollar index because we've been giving back that initial breakout. We're now right back to the 92 handle, approaching that 50-day moving average. It's been pretty much a week of the dollar index consolidating. Do you think this is a change in trend, or is this a buy on dip?
No, I don't think it's a change on trend, and I'm not sure what the trend really is. I feel very strongly that the trend for fiat currencies generally is that they're being devalued in real terms. Dollar index is just a measure of the U.S. against other currencies. It's a question of the race to the bottom, who's devaluing the fastest. So I don't really have an opinion on where it's headed from here, and I'm not really that concerned with it because I don't pay as much attention to the dollar index as I used to. On the other hand, when we get to gold, we might have something new to talk about.
All right, well, let's move on to crude oil because more or less we continue to just be in consolidation week over week. Really, nothing has changed. We continue to straddle this $60 level. What's next for oil here?
Well, Patrick, crude oil drew down 3.5 million barrels in this week's inventory report, with Cushing, Oklahoma drawing down 735,000 barrels. Now, it sounds like big drawdowns on crude oil. That should be a big bullish surprise. The thing is, there were builds on finished products, particularly on gasoline, 4 million barrels, gigantic build there, and then distillates, 1.5 million barrels, more than offsetting the drawdown in crude oil inventories. U.S. production ticked down 200,000 barrels to 10.9 million barrels. And big picture here, Patrick, I see three possible scenarios. Number one, the bottom is already in at 57.25. That was more than 2 weeks ago, back on the 23rd of March that we hit that number. And we've been really just consolidating sideways ever since. Maybe that was it. Scenario number two would be that one last push lower. Maybe we take out 57.25 and get down to, 56.80, something like that, just below $57 to take out the stop orders that exist down at that round number. But if that doesn't hold and it moves lower, then I think we're probably headed all the way down to the 200-week moving average at 53.48. Why don't we save the rest of that conversation for the post-game segment when we can look at a chart, and I'll explain why, if 57.25 doesn't hold. And so far, it's looking like it might hold. But if it doesn't, I think we could be looking at a bigger move down to 53.50 or so.
All right, well, let's move on to gold because it's been a solid week of gold advancing. I mean, we're pretty much at this stage about $70 off of the lows and approaching that 50-day moving average. What's next for gold in your mind?
Well, it's not even a number of dollars over because, frankly, when we got to almost the same level back in the middle of March, it just felt like everything about that rally off of the first time we hit 1680 was just sluggish and half-hearted and not really there. On the other hand, this rally off of the second test of 1680 has really seemed to got some legs to it. The rally felt exuberant from the beginning. Those first couple of days were really strong. Then we navigated through the short-term moving averages very quickly without a whole lot of resistance there. We're not quite at the big test, which is the combination of the 50-day moving average, and it's also co-located at about 1768 or so with the channel resistance line. So there's a test to get, let's say, over 1770 and stay there for a few days. That's the first really big test. Once we've gotten past that, I think there could be a heck of a lot more upside for gold. So was 1680 the final bottom, or do we still have lower to go? I think we're going to find out in the next week because we're just coming up on where this should reverse if it's going to reverse. That would be right around 1770 or so.
All right, let's just touch on that 10-year Treasury yield because we really seem to, over the last couple of weeks, hit an overhead resistance level that has really stalled it out more or less around the 1.75 level. Do you think that's it for this advance in the yields?
Well, I think it ties very much back to the last question about gold. The reason I think that gold looks so good on the chart here is because the 10-year yield has apparently found its limit at 1.75. Now, if it turns out that that's not a limit and we go to 2% in the 10-year, I think there's another bigger wave down in gold coming. But so far, it looks like the gold chart is kind of confirming what we're seeing in the 10-year chart, and it looks like maybe 175 was as far as we're going to go for now. It's all related. Let's see what happens next week.
Now, this week's featured interview guest is Jesse Felder. Now, Erik, why did we invite Jesse back onto the show this week?
Well, Jesse is one of our favorite guests, the listener favorite from way back when. Very smart guy, produces his own podcasts, not as frequently as MacroVoices comes out, but when he does, they're terrific. And it's just been overdue to get Jesse back on the show. Sorry, folks, he's not a deflationist. We've got a deflationist coming up for you next week, though.
Erik's interview with Jesse Felder is coming up as MacroVoices continues, right after this message from our sponsor.
This episode of MacroVoices was made possible by Abex Technologies, which also sponsors the Smarter Markets podcast, which airs every Saturday morning and explores how markets themselves could be redesigned to better serve market participants and society as a whole. My interview introducing Michelle Dennedy as a new host for the Smarter Markets podcast is already live at smartermarketspod.com. Then Saturday morning, you can hear Michelle's interview with Jim Whitehurst, the president of IBM. And a fascinating conversation, I'm sure. I'm going to be looking forward to that one myself. But you won't get Smarter Markets on your MacroVoices feed. You have to separately subscribe to Smarter Markets in your podcast app to receive this free new podcast.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Jesse Felder, publisher of the Felder Report and former hedge fund portfolio manager. Jesse, it's great to have you back. Listeners, Jesse did prepare a chart deck to accompany today's interview. You'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not registered yet. Just go to our homepage, macrovoices.com, look for the red button above Jesse's picture that says looking for the downloads. Jesse, great to have you back. I've been starting all of our interviews asking people about, so many smart people have turned into inflationists in the last year or so. Where do you stand? Are you inflationista, as Louis Vincent Gav called it, or are you still in the deflationista camp?
I am in the inflationista camp. And, Erik, I got to say, it's great to be back. It was, I think, a little over a year ago when we last spoke here and, right before the COVID crash. And it's kind of been an interesting 13 months since then. But yeah, I am in the inflation camp. I think that we're going to see, to me, one of the things I look at is the, just prices paid components of a lot of these things that we've seen. ISM services came out this week, but businesses of all stripes are all basically complaining about rising cost pressures. And I think we're seeing that in tons of different sectors, from manufacturing to restaurants. I think we're going to see some pretty strong wage inflation over the next few months, which is one of the things that can be a driver of inflation going forward.
Jesse, some people are saying this is just a little cycle of inflation. Other people are saying, look, the game has changed. We really politically are seeing both more emphasis on fiscal spending and also an emphasis on getting money into the hands of Main Street as opposed to Wall Street, and maybe not really pursuing QE the same way that we used to in the past. Do you see this as a secular shift to inflation? And regardless of whether or not you do, what do you think the main drivers are?
Yeah, I do. I think we're seeing some, obviously some cyclical signs of inflation just based on, the base effects and things that, the depressed numbers we saw a year ago. So the year over year numbers are going to show kind of cyclical inflationary pressure, which we're seeing. But I think I'm also, from a secular standpoint, an inflation bull. I do think that there are a number of dynamics. One you mentioned, which is really important, is we're seeing fiscal stimulus this time that is dramatically more significant, larger than what we saw during the financial crisis. Obviously QE, everybody likes to say that, QE was going to be inflationary. There were a lot of warnings, 2010, 11, that this was going to cause problems, and those never materialized. And I think that was because we entered into a period of, relative fiscal austerity with the rise of the Tea Party and things. And we're just not seeing that. We're seeing the exact opposite. In fact, I think a lot of people that are arguing for increased fiscal stimulus today are pointing at that earlier period and saying, we made a mistake in not doing enough fiscal back then. We're certainly going to avoid that mistake this time. I think we're seeing, multi-trillions of dollars of spending. And I think the other side of it too, in terms of longer term secular dynamics, are two things that, demographics and deglobalization. So I think, those are two of the big factors that have proven disinflationary over the past several decades. Demographics, to me, I look at the baby boomers coming into the workforce as a huge, kind of supply shock, labor supply shock that helped, to depress wages and things. And at the same time, we had, huge labor supply shock with globalization. It's being able to send production overseas. Both of those together really, I think, kept prices under wraps. But now we're seeing, I think, a lot of the things I think people are maybe underappreciating today is the fact that all of this monetary policy has created a huge incentive for people who, over the last 10 years or so, people who have probably stayed in the workforce longer than they otherwise would have because of the weak economy and, retirement accounts and house prices, went way down. Now we're seeing just the opposite. This time we're seeing stock prices elevated. All these retirement accounts have done really, really well, and home prices are again soaring. So I think that's a huge incentive for a lot of these people who have stayed in the workforce longer than they otherwise would have to now retire finally. And baby boomers leaving the workforce is the kind of the opposite of that labor supply shock. And is inflationary. Same thing with, China is no longer able to, be the perpetual low-cost supplier. They've have rising costs and things now. And to the extent that we want to bring home, production to the United States, and there's been a lot of talk about making supply chains more resilient and these things, these are all kind of, I think, inflationary from a secular standpoint.
Let's go ahead and dive into your chart deck. On page 1, you've got a chart of the S&P 500 on a fairly long time scale, and it looks like we see a megaphone formation here. What's going on?
Well, I think, this chart to me, I'm primarily a fundamental type of value investor, but over the last 15 plus years, I've really been integrating technical analysis into my process. To me, the technicals today hold clues for investors and traders alike that are really important to understanding what's going on. I wish I could remember who brought this passage to my attention from Edwards and McGee, the technical analysis of stock trends. But the way they describe a broadening top pattern or megaphone pattern or whatever you choose to call it, I think is very eerily accurate as to what we've seen over the last several years. And so that, the pattern kind of dates back to late 17, early 18 when stocks kind of had a blow off, right, leading into the Volmageddon kind of mini crash. But the way they describe this is a broadening formation may be said to suggest a market lacking in intelligent sponsorship that is out of control. A situation usually in which the public is excitedly committed and is being whipped around by wild rumors. Nevertheless, the fact that this chart pictures of this type make their appearance as a rule only at the end or in final phases of a long bull market lends credence to our characterization of them. To me, that's, when you consider the extremely risky, highly leveraged strategies we've seen. I mentioned Volmageddon, the short vol trade. More recently, we've seen the YOLO call buying and just absolutely off the charts, bigger than anything we've seen. And then, Archegos utilizing swaps to get 5 times, 5-to-1 leverage. To me, this technical description from Edwards and McGee is really a perfect representation of kind of what we've seen in the past 3-4 years in the market.
And on the next page, we're looking at margin debt, this time expressed as a percentage of GDP. I'm curious, I haven't seen it done that way before. And one of my criticisms of people who use margin debt charts is they usually show just the nominal value. It's like, look, it's an all-time high. Well, yeah, okay, there's inflation. It's an all-time high. You're not correcting it to anything. I'm curious why you chose margin debt to GDP as opposed to something like margin debt to total capitalization of the stock market, which to me would seem like a closer representation of what's being leveraged.
Well, margin debt to market cap, the problem that I have with that as a measure is you're using, as the denominator, something that you're trying to analyze. And so to me, margin debt to market cap it would be the same thing as trying to, I guess, analyze or give somebody advice about a smoking habit. And, by that, you would say the larger your body mass index is, the less, your 2 or 3 pack a day smoking habit is a problem. And, somebody would come away from that saying, okay, well, the larger I get, the less smoking is a problem for me. And so to me, I think that's what the message is for margin debt to market cap. The bigger the bubble, then the smaller that margin debt would appear to be a problem when that doesn't make any sense to me at all. And so I do agree, you have to normalize it somehow. And so to me, margin debt to GDP shows the amount of leveraged, financial speculation relative to the overall size of the economy. And to me, I think you have to normalize it with something other than the market itself. And, the quote here, the reason I like to use margin debt, because there's so many sentiment measures, but I like to use real world kind of measurements to understand where we stand in terms of sentiment. My favorite quote in terms of margin debt is from John Kenneth Galbraith, who said, even the most circumspect friend of the market would concede that the volume of brokers' loans collaterals by securities purchased on margin is a good index of the volume of speculation. So I look at margin debt as the index of the volume of speculation. And if we look at it that way, then even a normalized margin debt figure shows that speculation is just bigger than, relative to the economy, is bigger than anything we've seen in modern times.
Jesse, as we move on to page 3, this looks like a riddle for the statistics experts in the audience. You're drawing a distinction between the median stock versus the average stock. Why that distinction, and what is this chart telling us?
Yeah, so I probably should have prefaced this, but I like to look at the market or even individual stocks or anything I'm trying to analyze from an investment perspective, utilizing, what my friend Todd Harrison calls the 4 legs of the investment stool, if you will. And that's fundamentals, sentiment, technicals, and macro. So the technicals, we looked out of the megaphone pattern. Sentiment to me is, we look at that margin debt as the volume of speculation. This valuation, is where we start to look at fundamentals. And so when you look at the price to sales ratio of the S&P 500, today it's about 10% higher than it was at the peak of the dot-com mania, it's astounding to me. I never thought we would see valuations surpass that measure, which was slightly higher than what we saw at the 1929 stock market peak. So we're higher than that today. Obviously, stocks are more highly valued than they've ever been in U.S. history. But what is most interesting to me about this is the median price to sales ratio of those 500 stocks is today 75% higher than it was at the peak of the dot-com mania. So I think not only are we seeing another stock market bubble, but we're seeing one that the breadth of the current stock market mania is so much greater than anything we saw 20 years ago. The average stock, the median stock within the market, is almost twice as expensive as it was 20 years ago. To me, that just suggests, back then the bubble was relegated to a handful of sectors, mainly surrounded, tech and dot-com stocks and eyeballs and those things. Today, it's not just relegated to one sector. It's a much, much broader bubble, in my view.
Jesse, moving on to page 4, what's going on here?
Well, this is an earnings model that I came up with. It was really inspired by an interview Stan Druckenmiller gave maybe a couple of years ago, where he talked about how he, the difficulties he went through at the peak of the dot-com mania. And, he famously was short some of those stocks into March of 2000 and then decided to cover those shorts and go long right as the market peaked, rolled over, and started to crash. He got out of those positions and decided he needed to take a few months off and kind of figure out what he was doing wrong. He came back in the fall of 2000, and he said he noticed that the dollar was rising, interest rates had been rising, and oil price had been rising. And that, trifecta is typically a good leading indicator of an earnings recession. And so I put together this measure, this kind of earnings leading indicator, based on just those three things. And you can see it does a pretty good job of forecasting where earnings are headed. Right now, we've seen, a really nice earnings rebound as we saw the dollar get hammered over the last, year. Oil prices went negative, obviously, and interest rates, went to the lowest levels in history. That was all kind of a bullish leading indicator for the S&P 500 earnings. But now we've seen, obviously, a nice rebound in all of these things. Interest rates going up, oil prices going up. The dollar's had a nice rally this year. So that all suggests to me that we're probably going to see an earnings peak sometime in the middle of next year. But, people say, okay, well, I don't need to worry about it for now. But as Stan has said, the market discounts, if you invest in the present, you're going to get run over. You need to look at where's the market going to be 18 months from now? And 18 months from now, earnings could be turning negative again, or we're probably already into negative territory. And so the market's going to start, it's this rally that we've seen has been, discounting this earnings rebound. But the market's now going to start probably having to discount another earnings recession sometime in the near future.
And we're looking at profit margins versus labor share on page 5. What do we mean by labor share here?
This data comes from the Fred St. Louis Fed's website. And to me, one of the things that people say, or people maybe don't appreciate about the stock market right now, is that over the past 10 years, we've seen record high profit margins for the S&P 500, for the broad stock market, really. And this has really come at the expense of labor share of income. And so labor share is inverted on the chart, and you can see there's a pretty high correlation, especially going back to, the early 70s, between labor share and corporate profit margins. And essentially, that just shows corporations, to the extent they raise profit margins, it comes at the expense of labor. And, Warren Buffett wrote about this back in 2001, 20 years ago. He suggested that this could never really persist. He was absolutely wrong that it's persisted a lot longer than he thought. But he said if it did persist, it would be likely to cause political problems. And I think that's exactly what we're seeing lately, which is political problems in terms of, labor deciding that it's getting frustrated, tired of losing share to corporations which are profiting on a historical basis to a much greater extent than they ever have before in history. So I think in order to kind of be, one of the things that's embedded in the stock market today, I think that's being discounted, is that profit margins will remain at record highs indefinitely into the future, and that labor share will remain at record lows indefinitely into the future. But I do think what we're seeing now is a major political shift that puts this at risk. We're seeing, the Biden administration talk about raising corporate taxes again. And, he's said he wants to be the most labor-friendly president in history. Well, the way you do that is you lower corporate profit margins. And to me, it's very likely that will head in that direction. To me, watching the developments on the political side of things just makes it more and more likely. And if profit margins revert to a more historical average, we're talking about a very significant change in valuations that would probably have to happen in order to reflect that.
Moving on to page 6, we're looking at stocks versus interest rates. And boy, if we look at where the chart is projecting, at least, it would suggest that there's negative interest rates being called for here.
Absolutely. I think, this chart essentially shows, the growth to S&P 500 ratio. Growth has obviously benefited, since 2006-7, growth has outperformed value to a historic degree, but it's also just outperformed the broad market to a significant degree also. You can see the correlation with this outperformance of growth to interest rates. Falling interest rates benefits long duration assets. To me, growth stocks are the longest duration of risk assets out there. And so, I guess it makes sense that falling interest rates would benefit growth to a greater degree. But growth stocks have outperformed so much more dramatically than even can be justified by interest rates. They've come to discount negative interest rates. Look at the chart. Essentially, growth by this calculation is discounting, negative 50 basis points on the 10-year. Obviously, the 10-year is not negative 50. It's 1.7 or something like that today. And it's up a couple 100% from its lows. If growth stocks are forced to reflect the change in interest rates, I think that they have a lot of outperformance to give back. That's one of the risks facing the market today, just based on interest rates. Is obviously growth stocks have become the far and away leaders of the bull market over the last 10, 11 years. So if growth stocks were to give up this outperformance, it would mean a significant thing for the broad stock market.
You've got a fascinating chart on page 7, which I don't recognize. What's going on here?
Well, this is just a long-term chart of the 10-year Treasury yield. This one was a chart I think I first saw Mehul Daya post on Twitter, or perhaps in a research note from several years ago. But it's fascinating to see that even though interest rates have been in a long-term downtrend, every time rates have backed up, we've seen some sort of a financial instability kind of rise to the surface. So obviously the 1987 crash happened. We saw rates go from 7 to almost 10% on the 10-year yield. That was not good for risk assets. Obviously, there were other things that contributed to the crash, but rising interest rates was definitely one. We had the Great Bond Massacre in 94. But the peak of the dot-com mania was also, in March of 2000, we saw rates go from just over 4% to over 6% during 1999. And I do think that's one of the things that contributed to the peak of the dot-com mania. Obviously, rates, from 2003 to 2007 were in a rising trend and contributed to the peak in the housing bubble. Raised the cost of capital, and it throws a wrench into a lot of these, bull trends. Again, 2009, 10, 11, we saw rising interest rates again contributed to the European sovereign debt crisis. We had the taper tantrum in 2013. And then in 2018, obviously I mentioned earlier, early 2018, we had the Volmageddon crash after interest rates, went from under 2% to 3% on the 10-year. And I call it the taper tantrum too, but the fourth quarter of 2018 was really a time when investors were freaking out about a normalization of monetary policy, not just obviously tapering QE, but raising interest rates. And so we've seen interest rates, the 10-year yield, rise faster, just as a percentage year-over-year change over the past 12 months than any time going back to 1986 at least. It's been one of the worst first quarters for the bond market in history. Typically, this shows that, we should start being concerned about potential financial instability. And to me, if you look back to that margin debt chart, obviously margin debt is not the extent of it. We've seen YOLO call option buying, like I mentioned, and then the use of swaps, by hedge funds and family offices like Huang's Archegos. These are the types of things that could become more prevalent as just a result of rising interest rates, potentially creating risk to financial stability.
Let's tie this all together, Jesse, because if I look at this whole chart deck, it seems to me you've made an excellent argument for valuations really being pretty darn stretched, looking like the very end of a bull market and getting ready to be the blow-off top that beats all blow-off tops from ever before. The thing is, we've really made this argument quite a few times over the last few years, and it seemed to be true. And then we just found that the markets just grind higher. I wonder if we should be considering that we really are in a different paradigm. And it's not that it's different this time. It's that the game has changed in the sense of what the government participants are doing. And, we've never seen unprecedented central bank action like this ever before. And it seems to me like what's going on, even if you go back to page 3 in your breadth chart, this time around, it's not just the darling names, it's the whole stock market. Well, I think that's just because there's an insane amount of central bank supplied liquidity that's pressing ETF flows, huge amounts of money into ETFs that are buying the broad market. What are your conclusions? I mean, I guess I've become skeptical of a conclusion that this has to be the top because we've been down this path so many times before.
Yeah, I absolutely agree with you that, monetary policy has created an environment where they've just flooded the markets with liquidity. And, obviously, whether that is actually supportive of risk assets or it's just supportive of animal spirits is probably, open to debate. But I do think that we are approaching a time, and this brings it back to kind of the inflation debate, that the Fed is going to be forced with. They've said they want to allow inflation to run hot for a time, but I do think the Fed's going to be forced with a very difficult choice at some point in the very near future, potentially, which is allow inflation to run hot and potentially out of control, or start to normalize monetary policy in order to deal with inflation. And at that time, that's when they risk crashing the stock market again. Because if you look at how the market reacted in late 2018 to any attempt to normalize monetary policy, it's pretty clear that the market's going to react very poorly to rising interest rates, rising Fed funds rate, a normalization of this 100 or a tapering of this 120 billion a month that they're buying of treasuries and mortgage-backed securities. So I think the debate is going to start over the next few months whether the Fed has to start talking about normalization of monetary policy. And as I said, the market discounts roughly 18 months into the future. Already, we're looking at, I think the markets are pricing in 2 rate hikes next year. If it's true the market is going to discount that well in advance, then that means prices are going to have to start reflecting a normalization of monetary policy relatively soon.
Well, Jesse, I know one thing that we agree on is that the backdrop that I think is pressing a lot of this is a move toward, I think, secular inflation. I mean, on one hand, I see what you're saying about these valuations being stretched. Inflation is usually good for the stock market, at least for the first few years. So how would you see this playing out in stocks? But let's also talk about other assets like precious metals.
Well, I think, I would actually probably debate that inflation is not great for stocks, and especially a stock market that has come to discount record low interest rates indefinitely into the future. I mean, I think the TINA trade is obviously one of the things supporting the stock market. There is no alternative to owning equities, but we're now seeing rates, back up, and I don't think they need to back up much to provide a real alternative to owning equities. You can look at any forecast you want. I use the Warren Buffett indicator. Market cap to GDP has a really about a 90% negative correlation with future stock market returns. Right now, it's saying, on average, over the next 10 years, the stock market could lose 5% plus, which kind of lines up with forecasts from GMO and things that show over the next 7 years stocks should lose 5, 6, 7% a year on average. Inflation obviously would put even a bigger exclamation point on that. I guess the death knell for the TINA trade. But there are obviously areas within the stock market. I've been very bullish on energy stocks. I think we talked about it last time I was on last February, but it was last fall, I did a podcast with Lee Gehring and was, about as pounding the table bullish on energy as I ever get. I still think energy stocks are very cheap, and people don't appreciate how the supply and demand dynamics have shifted in bullish favor for energy stocks. And the valuations, like I said, are still very cheap. So, I'm looking to add to those on any weakness. But I do think, the most tried and true way to deal with inflation is gold. And ironically, despite literally unprecedented deficits, unprecedented money supply growth, unprecedented fiscal support for the economy, we're seeing sentiment towards gold turn very, very negative. I think we've seen outflows out of the GLD ETFs. We've seen DSI, the Daily Sentiment Index, get back down to very low numbers of bulls. And we've seen the commitment of traders been showing pretty dramatic shifts in futures positioning. To me, I think it comes back to real rates, and we can talk more about that. But I do think that which has been a headwind for gold over the last 6 months or so is poised to shift into a tailwind.
Okay, Jesse, where you say that's a shift to a tailwind, that could either be because you expect inflation to increase or nominal yields to decrease, or both. Which is it?
I think one of the problems that gold investors have had over the last 6 months is they've been looking to TIPS implied real yields, which have been manipulated by the Fed. The Fed's been buying so many TIPS, since they re-upped QE a year ago, that they've come to. Daniel DiMartino Booth has done some good work on this, but I think they own 10% of the market a year ago, and now they're pushing 30-40% of the market. So they're manipulating TIPS prices so that you're not really getting a real signal there, I think, for where real yields essentially are. There's a very, very tight correlation between the gold price year over year and the 30-year Treasury yield less core CPI. And core CPI obviously has been falling over the last few months. I think it's down to 1.3% or something like that in February, which is pretty low. And while the 30-year yield has been rising, and so real rates have backed up over the last 6 months. That's been that headwind that I mentioned for gold prices. But now I do think, like I said before, we've already seen the biggest rise in rates, whether you're talking about 10-year or the 30-year, in decades. We've already seen a massive, it doesn't seem like a massive backup in yields, but on percentage terms, it's pretty significant. At the same time, we've seen core inflation come down. So I do think I don't know. I don't really have a strong feeling of where nominal rates should go. I think they could probably just kind of go sideways for a little while. But I think it's very clear core CPI is going to go from 1.3 to well over 2, if not even 3% or something like this over the next several months. And so the question in my mind is, okay, let's imagine that core CPI goes up 150 basis points over the next few months. Is the 30-year going to go up more than that? Is the 30-year going to go up 200 basis points? And I just don't see that happening. I don't see, the 30-year going much over 3% without the Fed, kind of coming in and saying, hey, we just can't afford higher nominal yields, not necessarily just for the economy can't afford it, but also the federal government just can't afford for the cost of all this debt to go up too much. Obviously, yield curve control would be the most bullish development for the gold price that you could imagine. And I don't think we're there yet, but I do think core inflation is going to rise much faster than nominal rates over the next few months, which I said is that tailwind for the gold price.
Now, there's an argument, it's not my view, but let's talk about it anyway, which is some people are saying, look, gold has been around for a long, long time, but it's been replaced with something better. And some people would say, look, the reason that gold has seen all this weakness has nothing to do with real rates and everything to do with the fact that so many younger investors are favoring Bitcoin and other cryptocurrencies rather than gold for the same reasons that people have historically invested in gold as an inflation hedge or currency debasement hedge. Whether or not you and I happen to agree with that logic, it is true that that's what's been happening. So doesn't that explain why the gold price has been kind of weak?
Not from my perspective. I look at it, and as I mentioned, real rates have been rising, and gold has literally just followed that playbook. The correlation remains very, very tight, and so to me, that is the explanation for gold prices. Obviously, that doesn't necessarily explain the sentiment. Sentiment's usually just driven by price, but there are also these narratives. They're important narratives, and I think that they do help you understand the sentiment behind gold. But 6 months ago, last fall, or last summer, July, August, when gold was over 2,000 an ounce and things, we weren't hearing about these narratives. So a lot of it is just price driven. Bitcoin has done very well. And so you're seeing a lot of euphoric sentiment in the crypto markets. Ethereum has done even better, while gold has done poorly. But to me, a lot of this trolling of gold bulls. I mean, to me, it was fascinating to see this week, very reminiscent of Jason Zweig's call back in the summer of 2015 when he called gold a pet rock. Turned out to be a terrible call. I'm a big fan of Jason's work, but turned out to be a terrible call. We all make them, so it happens. But gold price was $1,000 or something like that, $1,050 at the time, and it's obviously doubled since then. But this week, it was interesting to see that sort of sentiment crop up again. Bloomberg piece came out, saying gold is basically being proven as worthless asset, and I think even they trotted out the pet rock epithet once again, which to me is almost the perfect sentiment signal that it's a great time to be adding to gold positions.
And where's the opportunity, in bullion or in the mining shares?
I like bullion, but I also, there was a very large insider buy in Barrick Gold recently, and that's one of the things that I track closely in terms of when I'm analyzing individual stocks. Barrick has gotten very cheap again, but it's obviously kind of just a one of the main kind of indicators for the broad sector in terms of the miners. So miners are probably attractive too. My friend Tavi Costa's put out a chart this week too, showing that the miners relative to the gold price, the ratio is breaking out again from a downtrend. So that's another bullish sign. I think, it all depends on your risk appetite. I like to have a core in the, position in the metal that I kind of trade around. And, I kind of use the miners as a bullish way to kind of trade that. So I think that's, obviously they're more higher volatility, higher beta, and it, just depends on what you're using it for. I prefer gold for an asset allocation, and I prefer the miners for trading.
Jesse, I want to touch on something. Every time I hear one of your interviews or read something from you, I think of you as the dyed-in-the-wool value investor kind of guy. And what I have a hard time reconciling is it seems to me there's nothing that's cheap and hasn't been anything that's cheap in a long time. Does value investing still work as a strategy in this era of overpriced assets? And if so, where's the value?
Well, I think so. The last time we spoke, like I said, I think it was mid-February or something last year, early February, leading into the COVID crash. And we did talk about a couple different stocks that I was looking at. I think I mentioned energy at the time. I mentioned Bed Bath & Beyond and, Mesa Rich, which is a mall operator. Those stocks, I was buying Bed Bath at, $4 a share at the March lows. And it got caught up in that GameStop kind of Wall Street bets mania. And so it had a fantastic return off of the lows. I do think, to me, it's important from a value perspective. I'm not a big fan of quantitative value because I think you're absolutely right. I think that there's very little value in the broad markets. And so trying to pursue quantitative value, you're just not going to be able to be as focused, I think, as you need to be in finding these individual situations. It's funny, too, that, I'm not necessarily a resource investor, but that's where value has led me to the energy sector. To me, it was astounding to see energy stocks get so cheap. I mean, like a fraction of their liquidation value last fall. And as I said, they're still cheap. And it's not necessarily part of my framework, but I think it's interesting or fascinating to see that a lot of these individual stocks, energy stocks and things, do fit into, a larger framework of a macro view towards inflation. What are the sectors within the stock market that do well during an inflationary environment? Well, real estate does pretty good, but energy stocks do phenomenally well. The rest of the equity market, not so hot at all. Actually, everything, usually suffers as a result of price pressures and things. But also, I mentioned 2015. To me, gold got so out of favor in the miners, New Gold and Gold Corp and these things that were trading at literally like 30 cents on the dollar in terms of liquidation value. I think that value, started to really outperform last year. And to me, I wrote a piece about that insiders in March and April, corporate insiders, CEOs, CFOs, were betting heavily on a reversal in that outperformance of growth over value. I saw so much insider buying in energy and financials and these things that were considered the value sector of the market. I think value is still going to outperform, but I think, as a factor, value may just, if the market is going through kind of a peaking process right now, as I think it might be, value as a factor may just lose less than the broader market, than especially growth stocks and things. And it will, pay to be much more targeted in your approach and not try and own value as a factor, but try and look for specific situations that offer a margin of safety. And like you said, those are few and far between, but when you do find them, they work very well.
Well, Jesse, I can't thank you enough for a terrific interview. Before I let you go, tell our listeners a little bit more about what you do at the Felder Report. What's the status of the podcast, and what other information can they find there?
Well, the podcast is still sporadically happening. As I mentioned to you, Erik, I think you're still I think you've been on the podcast twice, and that's the most anybody's been on it. So I'm obviously a huge fan of you and your views. I do the podcast when I have something that I think I need to bring to people's attention and when I'm not too lazy. So like I said, last fall, I had to reach out to Lee Gehring and a resource investing expert and get his opinion on energy, because it looked like a terrific opportunity. So I'm trying to, throw in some episodes there and keep the blog going, where I kind of feature some of these, snippets of just some of the topics we talked about today.
Well, Jesse, I can't thank you enough for a terrific interview. Patrick Ceresna and I will be back as MacroVoices continues right after this message from our sponsor. Well, finally, after months and months of being sold out of advertising space, we finally have a few open ad slots in Q2. For anyone interested in advertising on MacroVoices, please contact us by emailing sponsorship@macrovoices.com. Let's leave it there and get right back to the program.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Jesse back on the show. So many of his views I share in terms of just where we are in the state of the markets and opportunities in everything from energy to gold, or even just how overbought the markets are. I guess the real trick always is, though, is that knowing the markets are overvalued and that things are a bubble, it doesn't really always help you, because it's always surprising how long these things can last and how far they go. Really, the art is to try to determine when the liquidity shift occurs that causes many of the corrections that follow after such an excess in the markets.
Well, Patrick, as the old saying goes, markets can stay irrational for longer than we can stay solvent. So it'll be interesting to see what happens. Let's move on to this week's post-game chart deck, because something a lot of people have been wondering for a long time is how long can rising real interest rates drag the price of gold down before people wake up to what I think is obvious, which is inflation's coming, guys. The title of the chart deck is Time for Gold, or Time for Gold ? Is it time for gold? Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not registered yet at macrovoices.com. Just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads immediately above Jesse Felder's picture. Patrick, what do we have here? It says, is it time for gold? And then on the very first page, we've got the S&P 500.
Well, we're going to just go through the markets just for a quick update, and then we'll talk gold at the end of the chart deck. So just a quick update on the S&P 500, which is now extended up towards that 4,100. This is actually a very critical moment for the S&P. There's a couple of these targets that we had up here as we approach 4,100. And when we look at it, the NASDAQ is slowly approaching its previous high, which could act as an overhead resistance. And so while the trend is very much still upwards, this is actually a really important moment in the markets. And when we go to page 3, when we look at that Russell 2000 small cap, what was particularly interesting is the fact that the small caps have actually not participated in this leg of the rally. And this is really interesting because the Russell has actually been one of the leadership indexes from the November lows. And we've really now seen that transition a little bit. There are some technicians out there that are trying to cookie cutter that head and shoulders topping formation potentially forming on the Russell. I think it's a little early to be all in that camp, but certainly the underperformance of the Russell is something we can't ignore. And what's particularly interesting about that is on page 4, when we have the ratio of the Russell over the NASDAQ, the Russell outperforming the NASDAQ has really been the trend in place, largely driven by yields. And so when yields were skyrocketing higher, we saw all that money flow heading into small caps, cyclicals, and financials. And really those FANG stocks and many technology names were dragging in that period. But since that March 18th low in yields, we have actually seen this trend shift. And really the question I have in the back of my mind is have we seen sort of that reflation impulse that's driven those sectors and those parts of the stock market that have outperformed? Have we seen a transition point where that is now stalled and we're going to go back to what's worked, back in 2019? And that's going to be really interesting as this develops.
Let's move on to page 5. Bitcoin hasn't quite broken out above 60,000 yet. Remember when 30,000 was a really big deal, like
it was
a month ago?
No, it was, and what's interesting here is that there was some chatter on the internet and on Twitter about the idea that Bitcoin could be topping, or something it's at least we can say that it's running out of momentum, because it certainly has not been making higher highs over the last couple months. But I still don't think that there is any real structural technical damage other than those divergences in momentum. And the way I'm looking at this here is that if we can see Bitcoin still hold above that kind of 53 to 55,000, we still have to give the bulls the benefit of the doubt that they're in control of this market and they could still impulse it up to 70,000. But this is actually a really critical moment, because the more divergence you have in the loss of momentum, the more likely it is that the bulls will drop the ball here. And I'm not predicting that they will, but this is a moment where we have to watch very, very closely as to whether or not the bulls can really take this off to new highs.
Well, Patrick, I had to laugh as I looked at page 6. You've got the chart that I sent you on the left, and you've got your own big picture trading chart on the right. You didn't title this decluttered version of Erik's chart, but I know our listeners are thinking that.
I mean, all we really wanted to do is just show where we stand on oil. And one of the things that you were illustrating here, I'm not going to put words in your mouth, I'll let you explain it there. But I mean, the question here is if the 50-day doesn't hold, how deep can this correction go? The one thing in my mind is that I think that while I remain bigger picture bullish crude, my spidey senses are just like that there's room for this still to be a little bit deeper. And I know you had some lower targets. What's on your mind?
Well, Patrick, great minds think alike again. Now, it is possible that this is ending and that we've seen the bottom and that it's all going to get better from here. But frankly, if you look at the chart on the left, look at that yellow trend line that we've stayed neatly below without even testing it once. Look at the fact that we've really taken out even the 55-day moving averages, which are the red ones at the bottom, on an intraday basis with some significant moves below them. All these things say to me that maybe there's more downside still to come here. The test is going to be if the current low at 57.25 holds or not. We could get another retest of that level, maybe even just a little bit lower than that level to shake out the weak hands, and that could be the bottom. But if you see 57 getting taken out to the downside with any kind of momentum behind it, it says to me that this level broke and that we're headed to the next level down. So where is that next level? Well, look at the one significant consolidation that we've had in the middle of this rally since the beginning of November. And it's in the month of January, and it happened right around the 200-week moving average, which is now 53.48. That's circled in the red oval on the left side. It's also conveniently just about $1 below the 38.2% retrace level, or I guess the other way you could say it is it's halfway between the 38.2 and the 50% Fibonacci retrace level of the entire move up from November to the beginning of March. So, if I had to guess what happens next, maybe this holds. And the reason I say maybe it holds is every other time in the course of this rally that I've thought we were going to have a major correction, it turned out to be shorter lived and less downside than I expected. I think this one might be different. If it is different, where we go down to probably is around 53.50. I would be surprised if the gods of OPEC let it go much lower than that. And you've got a whole bunch of support there, whether it be the January highs, which were resistance then that become support now, whether it becomes that 200-week moving average, which is pretty stable there at 53.50, if it's the 100-day moving average, which is rapidly increasing through 53.86 right now. Big cluster of support there. I think that's probably where it goes. The next big cluster of support after that doesn't come until $48 or so. I don't think we're going that low. I don't think OPEC will let it go that low. So that's a range of possibility. If we do get 53.50, I will be buying and adding to my long positions in size. I think that's a tremendous buying opportunity if we get it.
It's funny that's the very levels that I'm thinking as well. The 50% retracement's down around 52, but that consolidation, 53.50 area, would certainly be a place where if the 50-day doesn't hold, that things could get washed out down to that level. But like you were saying, I think that would be a really interesting level to test out as a buy on dip. And so let's see whether the market gives it to us. But what's interesting is I wanted to go on page 7 and look at the energy ETF, which is the energy company themselves. This is using that spider ETF, the XLE. And what's interesting is we're consolidating along the 50-day moving average on this one as well. And we're at that same kind of a juncture. And what's interesting here is that if we did see that break on crude oil to take and test that next little level lower, this could send the XLE down toward that kind of 44, 45 level where the highs were coming in back in January. And that will also be a point of high interest for me in terms of whether or not a buy on dip would emerge there if we had a quick washout down to that level. I know Jesse was talking about these energy companies, but after such an extraordinary run, really waiting for a buy on dip was the only really sound strategy to do. But the big question is the buy on dip here now, or is it going a little bit lower? And that's something that I'm going to be watching in the days and weeks to come.
Let's move on to copper futures on page 8. What do you see going on here?
Well, I didn't draw the trend line in there like you had there on crude oil, but you can basically connect those highs from February and mid-March and realize that earlier this week we had a breakout attempt on copper to break to the upside. And so far, the bulls have dug in and are relatively consolidating well in this breakout. It's going to be really interesting to see whether that 50-day moving average ends up having held up this and potentially the start of another bull advance in copper. And that's going to be interesting because naturally would think that the commodities trade would all sort of correlate and maybe copper, if it's breaking higher, is a sign that maybe crude oil won't be as deep of a correction. Who knows? I don't know if I want to overread into that correlation, but certainly the consolidation on both copper and oil started roughly in the same window. And it'll be interesting to see with coppers leading the way out of the consolidation.
Let's move on to gold on page 9. This one, boy, we've been well below that 50-day moving average ever since January or so, but we're right on the edge. What do you think is going to happen next?
Well, the one thing, interesting thing is let's go back to what we saw at the start of March, right? And there was this big washout in late February and the first week of March that basically saw gold heading down to 1675. And as always, there tends to be some form of a oversold reflexive bounce higher. And during that entire rally throughout the middle of March, there's no other way to classify. It was pretty pathetic. Like they had no follow through. It was very shallow. And and there was nothing really positive to say about gold during that bounce. Then when it rolled over and headed back down, that was the true test. And when gold at the end of March headed right back to retest that low at 1675, that was truly, in my mind, the break it or make it moment for that. Because if we gave out 1675, that was a real no man's land under that support. I mean, we had Ole Hansen talking about the significance of that level. There's a lot of really smart people that were watching that as a level. And the fact that gold was able to reverse and with some more meaningful velocity off of a retest of a key support line is the first positive thing we've seen in gold in a while. And we're slowly approaching retracement levels, moving average levels. There's a lot of work for gold to still do to start repairing the chart. But this is the first positive sign we've seen in gold in a long time.
I couldn't agree more, Patrick. If I just look at this chart, the last time I see a 1 week or 2 week rally that looks this exuberant, I've got to go back to last year in early December to find, this kind of pronounced upward movement. And it turned out that was a spirited rally that took us up to the beginning of what actually was this unwinding. So it's going to be very interesting to see where it goes from here. In the big picture, grand scheme of things, I think the secular inflation story is very real. The price of copper has more than doubled since it bottomed in March. I think the price of gold is going to more than double before this is over, and I'm certainly not predicting that tomorrow or next week. But it's going to be very interesting to see if this is the bottom or not, Patrick. And I think that answer is going to hinge entirely on whether or not we've seen a short-term top in U.S. Treasury yields. But let's move on to Chart 10, a golden wall of worry.
So when we're looking at this chart, it was an interesting one that was on Twitter, and it was basically showing the gold newsletter sentiment index and just how negative things have gotten. I mean, we're at basically 2-year lows in terms of sentiment toward gold mining stocks. And that's also another kind of red flag for me in terms of the fact that sentiment has gotten so negative that often these are things that are associated with bottoms and key turns. And so it's really interesting to see that at the same time as we're seeing gold creating some key tests of support lines and starting to try to roll up, really the sentiment couldn't be more negative.
Let's move on to page 11. Now, as much as we have not yet seen any real breakout through the moving averages on bullion, we do see it on the gold miners ETF.
That's right. What's particularly interesting to me about the gold miners is the fact that in the month of March, we saw silver break to a fresh monthly low. We saw gold go and retest its low. But during that time, the sell-off that we saw on the tail end of March in the gold miners did not go and retest their lows. It actually never really accelerated to the downside, almost like the selling has all been exhausted already. And as soon as there was some reaction in gold and silver off of their lows, the miners were very quick to break out above that moving average. And I've seen this in the past where a lot of traders that believe it's a key turn point in the markets will act first on the miners before we start seeing it on the precious metals themselves. And we've seen that in the past where we've seen the constructive price action emerge in this space first. And the fact that we're seeing this starting to turn up is certainly got my interest.
Now, Patrick, you're doing a special webinar exclusively for your Big Picture Trading members titled The Best Gold Buying Opportunity We've Seen in Years. What are you going to be covering? Tell us more about it.
Sure, Eric. I do believe it's the time to act. So back in 2018 and 19, I presented at the VRIC and shared with our MacroVoice listeners the way we approach commodity cycles and how we use options to position ourselves both to manage the risk and to leverage returns. We are now approaching the right duration and depth of the down cycle. And I believe this is the opportunity to act right here. During the webinar, I'm going to be going through the analysis and execution of how to get in now and maximize on the upside potential and while minimizing that downside risk. And so I'm inviting all MacroVoice listeners to join me to this free webinar. All you have to do is sign up for a free trial to bigpicturetrading.com and you'll get access to this webinar. Now, even if you've had a free trial before, you'll be able to sign up once again. So I look forward to seeing everyone online for what I think is the best gold buying opportunity that we've seen in years.
Patrick, when is the webinar being held?
It's going to be held on Friday, April 16th at 9:45 a.m. But to those that can't attend it live, the recording will be made immediately available after the live event.
And, of course, there's information on page 13 of the slide deck that tells you how to sign up, or just go to bigpicturetrading.com. We're going to leave it there for this week's episode. This episode is brought to you by Abex Technologies, pioneering the design of smarter markets that better meet the needs of both market participants and society as a whole. Patrick, what can they expect to find in this week's Research Roundup?
Well, today you're going to find the transcript for today's interview, as well as a link to Jesse's slide deck and the chart book we just discussed in this postgame. There's also a link to a variant perception article titled Adding Back Central Bank Ambiguity, as well as a link to a Jeffrey Snyder article, Real Dollar Privilege on Display Again. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. That's Erik spelt with a K, and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.